Well, let's go and get his take on that report and everything else that's going on in markets in this latter parts of December. Trent Primmer from Barclays Pierce Capital joining us now on the program. Trent, it's great to go and see you there. All roads back to that inflation report in the States tonight?
Yeah, absolutely. I mean, look, there's two major macroeconomic themes at the moment, which is driving the market. Like you said, inflation is probably the biggest one. Second to that is Omicron. We're kind of touching briefly on Omicron. We're actually of the view that there's nothing really to worry about there. And we obviously bought the dip, which is proving to be sort of a favourable move at the moment, with equity markets sort of bouncing nicely as fears start to subside. The more pressing issue, like you said, is obviously the inflation number. And it'll be interesting. It's a difficult beast to read at the moment. We've always held the view that inflation isn't transitory. And it appears that obviously central banks are coming to the party on this thesis, and they'll obviously look to take action earlier than they anticipated.
Okay, so you bought the dip. We did see a bounce this week, although it looks as if we will end, well, in a bit of a fizzle yesterday and today. So what do you think going forward, sort of to the end of the year, with all the risks that we listed off the top, with Omicron, with inflation, with China? We could go on. Are you positioning a little bit more defensively going forward?
100%. I mean, and that's the key. It all depends on how you position in your portfolio. If you're still looking for that high growth, or you have exposure in the tech sector, or you have exposure to, say, consumer discretionary, obviously that spells out bad news. Inflation affects all of those sectors significantly. We're positioning ourselves more defensively at the moment as a result of the aforementioned macroeconomic environment. We're mainly favouring inflation hedging assets, real assets such as commodities, where businesses can start to pass on those higher pricing, infrastructure, and obviously, as we've discussed in the past, with you guys, we're really big on renewable energy, and I think that still has a very, very long way to play out. I think position your portfolio to obviously commodities, infrastructure, renewable energy is probably the way to go next year, and potentially, consumer staples, businesses like Woolies, Coles, obviously catering to consumers' needs and not necessarily wants, like your consumer discretionary
Interesting.
businesses.
Okay, when you talk about gaining exposure to renewables, through what vehicle? I mean, are we talking listed equities here in Australia? If so, what? Or do you look for private opportunities? Do you look for ETFs? Because it's such a wide remit right now. You could go for the battery. You could go for, more traditional, what you think of as renewable energy, like solar and wind.
Of course. That's a really good question. And obviously we have quite a breadth of opportunities, both in the unlisted and private space, as well as on market. Namely, some of the hydrogen ETFs, one of them, which is the Beta Shares Hydrogen ETF, which is HGen, definitely worthwhile looking at for a longer term hold. Pure Hydrogen, which is another hydrogen player, which is listed. Looking at copper businesses like Locksley Resources, which just released some fantastic results, which the market hasn't caught a hold of yet, but they will. Some more news to come on that front. Lithium, anything that has exposure to electric vehicles or the EV battery thematic, we expect to do quite well, as economies around the world are starting to transition away from traditional fossil fuel sources. That's going to take some time, but all the more reason to invest early and hold these good businesses. You're getting in at lower pricing. Obviously, if you're a big believer in renewable energy and a shift away from traditional fuel sources, longer term, it's worthwhile looking at these businesses. Namely in the private sector as well. There's quite a few green hydrogen plays coming up. One of which we've listed. We're about to list on the Nasdaq, which is Verdant Earth Technologies, and another coming through, which is Infinite Blue Energy. So we have quite a bit of exposure here at Barclays Pierce in that sector, as you would have guessed.
Hey Trent, in that resources space, the commodity space in particular, what are some of the bargains that you're seeing at the moment? How do you see gold? How do you see some of those other players? Where are the bargains right now?
Gold for sure. It's obviously it's a bit difficult. This market's going to provide a really good case study for future investors. You know, you're in a low interest rate environment. People have hot money. They don't want to park it in banks. But also, if you're looking at growth, I mean, a lot of things have run very, very hot. Particularly, like we say, we're pretty confident on commodities moving forward and the continuation of the commodity super cycle. I think looking at some of the well-diversified asset businesses, you know, BHP, Rios, I think probably for value at the moment, we'd look on the small cap end, something like Locksley Resources, PH2, which is in the hydrogen space, definitely gold, Evolution Mining, Northern Star are my favoured stocks in that area. And I think the market hasn't caught on. It's weird. It's not a typical correlation to how it should really play out in a high inflation environment. So I think getting in now, you're getting in at better pricing. Eventually, I think when things start to turn and, you know, interest rates rising and things start to be a little more real in the market, people are going to start buying up these businesses, and, you know, they're going to be allocating not small amounts, you know, 15, 20% positions to their portfolio in some of these sectors. So I'd for sure look at those areas moving forward.
Okay, so I think copper is an interesting one as well. Just to rewind, did you say Locksley Resources was one of your favorite picks in the space?
No, Locksley Resources,
Locksley.
LKY is the ticker code. Yeah.
Okay,
Yeah.
Thank you. I just wanted to clarify that.
Trent, I was going to go ask as well, banks. We're talking about inflation, we're talking about rising interest rates. That typically goes and lends no support to the banking system. How do you see that area at the moment?
You can play it two ways. Obviously, net interest margins start to increase as interest rates rise. We'd expect interest rates to start to rise, you know, probably by second half of next year. If you push me on a date, I'd say August, after the inflation numbers from July come in for quarter two inflation figures, because obviously we read through quarterly on inflation in Australia as opposed to monthly in the US. Banks, it's a little difficult. My view is that one of the big pressures for next year is probably going to be the housing market. Is there going to be an increase in doubtful debts because people have borrowed so much and overextended in a low interest rate environment? Are they going to be able to service those debts in a high interest rate environment, or an interest rate environment that's starting to obviously to increase? So a little wary on banks. We typically haven't really bought them since the Royal Commission. Really, we've looked in other areas and we've done quite well. And, you know, as the old saying goes, if it's not broken, don't fix it. But I think you could play it both sides. They could do particularly well. Generally, they're the lifeblood of an economy. So as interest rate rise, economies start to strengthen. Banks should do well. But like you said, there's a melting pot of potentially negative news. And it comes down to market sentiment. It comes down to how investors read that news more so than anything. So I think we just want to stick to what we know. We want to look at defensive portfolios and not really aim to knock the lights out. We want consistent growth, and we want to protect investors' portfolios and obviously their nest eggs, particularly in a time like this where the market's run very, very hard for quite some time in a fairly iffy market.
Right. Woolworths and Coles earlier on. What's your view on Metcash? We had a pretty strong update coming from the company just recently, and the share price has done very well off the back of it.
Look, it's not one that we've followed, to be honest. Like I said, we want to stick to what we know, but obviously Metcash, yeah, not one that we've looked at, unfortunately. I'm sorry.
When it comes to 2022, what is the biggest risk out there at the moment? Are you concerned about inflation, the virus, or is it going to be how markets sustain a period when you see money start to go and have a price attached to it?
Yeah, I think how investors look at the market once interest rates start to rise, that's going to be the biggest thing. And obviously the property market is one issue as well. There could be some pressure there with interest rates rising. Like I said, low interest rate environment. We've seen a massive rush for people taking on debt. You've also got a lot of people changing jobs at the moment as well, which some businesses still suffering because they're not even able to get staff in a period which we're calling obviously the Great Resignation. it doesn't correlate to how a market typically would with these events. There's a lot of ifs in the market, and like you said prior to me jumping on, is you've got geopolitical tensions thrown in there as well. So it could be a number of factors that end up causing a correction in the market, and I think it probably should happen next year. But we wouldn't be expecting that until rates start to rise around the second half of next year.
Lift off for the RBA. Trent Primmer from Barclays Capital. Thanks for joining us on the program and enjoy the weekend.